I'm Alan Kenny, Editorial Director with REIT.com, and I'm in New York for REITWeek 2014, NAREIT's Investor Forum. Joining me is Barden Gale, Vice Chairman with Mack Real Estate Group. Can you give us an idea of what it is that you guys are working on, what your platform is, and how you're involved there?
We're largely doing multifamily rental projects in urban areas, what a lot of people are doing, which scarce commodities, barriers to entry, located very close to transportation. It's what both the millennials and the empty nesters are looking for.
And so, what are some of the major differences right now between how private equity firms are approaching real estate investment versus the publicly traded REITs?
Well, we're really not a private equity group. We're an integrated owner, operator, developer. So we have all of those capabilities in-house. We are not a traditional fund group, so we do a lot with our own money, we do a lot with joint ventures, and we do a lot with family and friends. This is, it's not what I would call a traditional institutional private equity effort in that regard. Although we do have other areas that we invest in, such as debt securities. We have a hedge fund, and we own a management company, and so on. So we distinguish ourselves from the pure investors. We are an owner-operator. Now, distinguishing ourselves from the public REITs, I would say we're quite different. One, we are heavily involved in development. So whereas REITs will have between 0 and 5% of their portfolios in development, we are largely going to be a development company until we, of course, have created a reasonably sized portfolio in which event, obviously, our development will become less and less as a percentage. The main differences are, one, we can do a lot of development. Two, we can take a very, very long-term view on our assets. So we can hold land for a long period of time before we develop. We don't have to worry about paying out dividends. We don't have to sell assets necessarily to fund growth. We can do very complicated deals, very often tax-motivated deals with private individuals who've held land a long time. And I would say, very critically, we don't have to do large and impactful deals. We don't have to move the needle. Every deal, if you will, is an impactful one because we plan on holding it through multiple generations, and because we get to take advantage of the U.S. tax code through depreciation and so on. We can hold these assets in a tax-efficient manner for a long period of time.
And so in terms of growing the portfolio, like you mentioned, do you feel like the better opportunities are there in development or maybe through acquiring some standing assets?
Currently, there are still substantial spreads between development and the valuation of stabilized standing assets, and we're taking advantage of that. As that narrows, clearly what we'll do is slow down our development pace. In addition, we will look at turnaround opportunities. It's not to say we'll only do development where there are solid value-added returns that take advantage of our skill sets, which are development, operations, management. We're going to take advantage of those.
Well, Barden, thank you so much for your time.
You're welcome.
And for more on this and other REIT news and analysis, be sure to visit REIT.com.